Welcome to The Shifted Ledger, the podcast where we break down topics related to simplifying your workflow.
Thank you. It's great to be here.
Imagine an AI writing your quarterly board deck, but it has a 41% chance of completely hallucinating a critical financial metric.
Yeah, that is a terrifying thought.
Right, like you have just traded a minor reporting delay for a career-ending risk. So today, our mission for this deep dive into the sources is to unpack a really comprehensive SWOT analysis.
Right, the strengths, weaknesses, opportunities, and threats.
Exactly. Surrounding the implementation of artificial intelligence in the daily workflows of financial planning and analysis professionals and, well, accountants in general. Because for anyone listening, if you're trying to streamline your day-to-day tasks, this really is the ultimate frontier.
Oh, absolutely. It's a structural change that is, frankly, it's long overdue.
Yeah.
To understand the gravity of this shift, you really have to look at how corporate finance has functioned for, the last 50 years?
Oh, easily 50 years. Just, same old grind.
Right. The entire industry has been anchored to this historical, calendar-driven reporting model. A company operates for a month, the month ends, and then
the panic sets in.
Exactly. Then an army of accountants and FP&A analysts spend 2 weeks just frantically closing the books and analyzing what already happened.
Like corporate archaeology.
That is the perfect way to phrase it. It's an exercise in corporate archaeology. But what we are seeing now, driven by AI, is this transition to an event-driven, predictive framework. We are moving from a world where we report on the past to a world where we predict the future in basically near real time.
Wow. So the friction we are feeling in the industry right now, it isn't just about learning a new software interface. Like, it's not just a new app.
No, not at all.
It is about shifting the entire axis of finance from looking backward in the rearview mirror to looking forward through the windshield.
Exactly. It's a fundamental paradigm shift in how financial information is even processed and communicated to leadership.
But, before we get into the shiny new predictive AI tools and all the cool tech, we really have to look at the human reality that is forcing this change.
Yes. The baseline.
Because the current state of finance teams is, frankly, it's pretty grim. And if we don't understand the baseline reality of what the sources call the exhausted accountant, then the push for automation doesn't even make full sense.
Well, the baseline reality is exactly what makes this adoption mandatory rather than optional.
Yeah.
You have to look at the environment you're dropping this tech into.
Right.
Right now, according to the data we are reviewing in this deep dive, 70% of chief financial officers cite the already demanding workload of their teams as a major barrier to adopting new technology.
That is just such a fascinating paradox to me.
It is, yeah.
Like, they're literally too busy doing manual work to learn how to automate the manual work.
They're trapped in the cycle.
Yeah, exactly. The sources note that 46% of FP&A capacity is eaten up by manual tasks. And, just to ground that in reality for a second for you listening, when we say manual tasks in modern corporate finance, we aren't talking about writing things down with a quill and a paper ledger.
No, we are talking about data wrangling.
Right. We are talking about exporting a CSV file from an enterprise resource planning system, an ERP like SAP or Oracle.
Yep, the dreaded CSV export.
And then exporting another file from a customer database and spending like 4 hours writing VLOOKUP formulas in Excel just to make the two data sets talk to each other.
Precisely. It's just standardizing date formats, tracking down missing invoices, and reconciling intercompany transactions, literally row by row.
Which sounds so soul-crushing.
Oh, it is. And the psychological and physical toll of that is severe. The research shows 50% of office-based workers are reporting burnout.
50%. Wow.
Yeah, half the workforce. But the thing is, in finance, that burnout translates directly into operational risk. We are looking at a literal error epidemic.
Yeah.
18% of accountants report making errors on a daily basis.
I'm sorry, daily errors.
Daily errors.
Almost 1 in 5 accountants is making a mistake every single day.
Every single day. And 59% admit to making several errors a month. And they specifically cite capacity constraints as the root cause.
Wow.
When you stretch a professional that thin, where they're spending 65% of their time just collecting and validating data rather than performing higher-level analysis, the integrity of the financial data degrades.
And in corporate finance, data integrity is literally the only thing that matters.
Exactly. If the numbers are wrong, the whole business strategy is wrong.
It just feels like finance teams are running on a treadmill that just keeps speeding up.
Yeah.
And instead of giving them better running shoes, management is just handing them more weights to carry.
That's a very accurate analogy.
Which actually brings up a contradiction I want to push back on for a second.
Okay, let's hear it.
So, if a team is already burning out and they are already making daily errors because they are totally overwhelmed with their current tech stack, how does throwing a massive, complex technological paradigm shift like AI at them help? Doesn't that just add another heavyweight while they are sprinting on that treadmill?
It's a very valid concern, and it aligns perfectly with what researchers call change fatigue.
Change fatigue. Okay.
Yeah, Gartner actually reported a 50% year-over-year decline in the ability of finance teams to absorb change.
50%. That's huge.
They are exhausted. I mean, they've been through years of digital transformation initiatives that promised the moon and then just delivered another clunky dashboard they have to update.
Right. Another login to remember.
Exactly. But the macroeconomic environment is forcing the issue anyway. We are operating in a period of intense economic volatility right now. Inflation, changing tax policies, geopolitical conflict.
It's all moving so fast.
Yeah. 49% of CFOs cite supply chain disruptions alone as a top risk to growth. If your finance team is trapped in spreadsheets looking backward at last month's numbers, they absolutely cannot model the financial impact of a supply chain shock that just happened this morning.
Right. So the friction of staying the same has finally exceeded the friction of changing. The manual, heavy, error-prone workforce simply cannot keep up with the speed of global markets anymore.
Precisely. They have to change or they fail.
So if that is our baseline reality, then the immediate internal advantages of AI become very, very clear. Okay, let's unpack this. Let's look at the S in our SWOT analysis, the strengths, the heavy lifters of automation and efficiency.
Yes, this is where we see the most immediate return on investment for these teams.
So what does that look like day to day?
The most prominent capability right now is just the sheer automation of repetitive, low-value tasks. Using things like robotic process automation, or RPA, working in tandem with smart data integration.
Okay, so for you listening, if you hear robotic process automation and you immediately picture a physical android sitting at a desk hitting a keyboard, let's clarify the mechanism. We're talking about software scripts, right?
Yes, exactly.
Yeah.
RPA is a software bot that mimics human actions on a computer screen. It can open an email, you can download an invoice, log into an accounting system, and basically enter the invoice details.
Just clicking around like a person would.
Exactly. But historically, RPA was really rigid. If a vendor changed their invoice format slightly, moved the date field down an inch, the bot would break.
Oh, right, because it's just following coordinates.
Yep. But what happens now is that RPA is integrated with machine learning algorithms.
Mm-hmm.
So it doesn't just blindly follow a rigid rule. It can intelligently parse unstructured data.
Which solves that 46% manual task problem we talked about earlier.
Exactly. It handles thousands of transactions per second, it automates journal entries, updates the general ledger, and it performs really complex reconciliations across fragmented data sources.
The sources for this deep dive highlight a specific case study from Deloitte that really puts some hard numbers to this.
Yes, the audit platform.
Right. They developed an AI-enabled audit platform and deployed it across mid-size enterprises. And the result was a 40% reduction in manual effort.
40%.
I mean, if you are an overworked FP&A professional, wiping out 40% of your manual data wrangling is like getting 2 full days of your week back.
It's life-changing for those teams.
How does a platform actually achieve a 40% reduction mechanically, though?
Well, it comes down to how the AI handles anomaly detection and variance analysis. In a traditional workflow, an analyst pulls a massive data set, say operating expenses for the quarter across 50 different global branches.
Yeah, giant spreadsheet.
A massive spreadsheet. And to find out why expenses are over budget, that human has to comb through the data row by row looking for the anomaly. AI changes that entirely. The algorithm ingests the historical data and basically learns the normal financial behavior of the business.
Okay, so it mathematically defines what normal looks like for that specific company.
Yes. It understands, for example, that utility costs in the Phoenix office always spike in July, but travel expenses in the London office usually dip in August.
That makes sense.
So the moment there is a deviation from that highly nuanced baseline, say an unusual vendor payment or a bizarre spike in a specific cost center, the AI flags it instantly, in real time.
So, practically speaking, for you listening, the fundamental identity of the professional changes here. You go from being the person hunting for the needle in the haystack to the person who is handed the needle and asked to explain why it's there.
That is the exact shift. You transition from being a data wrangler to a strategic interpreter.
Yeah.
You open your dashboard on a Tuesday morning,
Hmm.
and the AI has already consolidated the ERP data, run the variance analysis against the baseline, and isolated 3 specific anomalies for you to review.
Wow.
Your job is to call the department head and find out what actually happened out in the real world, not to spend 4 hours building a pivot table to discover the anomaly in the first place.
And I guess this is how you eliminate that 18% daily error rate, too.
Exactly. You remove the tired human from the repetitive data entry.
Getting the books closed faster and automating those journal entries is obviously an incredible operational advantage. But, as I went through the source material, it became very clear that automating the past is really just the first step.
Oh, absolutely. It's just the foundation.
Yeah. The true transformative power lies in how AI allows finance to look forward. Which brings us to the O in our SWOT analysis, the opportunities. Here's where it gets really interesting. We are looking at the shift from hindsight to foresight.
This is the real evolution of the finance function. Historically, FP&A has just been a back-office reporting center. Predictive AI elevates it to a strategic co-pilot for the executive team.
We're talking about the transition from reactive number crunching to proactive business leadership. Let's start with generative AI and narrative reporting.
Okay.
Because anyone who has ever worked in corporate finance knows the absolute misery of staring at a massive variance data set and having to write a coherent management commentary for the board deck by Friday morning.
It is incredibly tedious because it requires synthesizing all this raw, quantitative data into qualitative readable insights. Generative AI, specifically using natural language processing, it fundamentally changes this.
How so?
Well, natural language processing, or NLP, allows an AI model to read and understand human language, sure, but also to translate structured data like a spreadsheet of revenue numbers into readable conversational text.
So instead of an analyst spending a whole day trying to explain a paragraph why revenue missed the target by 2%, the AI just writes the explanation for them.
It generates the first draft, yes. The AI can ingest the variance data set, identify the primary drivers, perhaps it was, currency fluctuation in the European market, combined with a delayed product launch, and draft a really comprehensive management commentary in a matter of seconds.
Seconds. That's just wild. But the real magic happens when we move beyond just writing reports about what happened in the past and move into predictive analytics and scenario modeling.
Yes.
The sources detail how machine learning can generate hundreds of what-if scenarios on the fly. Let's break down how that actually works compared to, traditional modeling.
Traditional financial modeling is highly rigid, and it's very manual. If the CFO wants to know the impact of a 5% increase in raw material costs, an analyst has to go into their Excel model, update the assumptions, flow it through all 3 financial statements, and painstakingly check for broken formulas.
Because there's always a broken formula.
Always. By the time they build a base case, a worst case, and a best case scenario, it might take a week.
And by that time, the market has probably already moved.
Precisely. Machine learning models, however, are dynamic. They can continuously ingest real-time external data. We're talking commodity prices, inflation indices, weather patterns, competitor pricing, and simulate hundreds of complex scenarios almost instantly.
The BlackRock case study in our sources is a perfect illustration of this kind of scale. They are analyzing more than 5,000 earnings call transcripts a quarter and over 6,000 broker reports daily.
The scale is almost unfathomable for a human team.
Exactly. Let's unpack the mechanics of that. How does an AI process 6,000 text-heavy broker reports in a single day and actually turn that into financial foresight?
It relies on advanced natural language processing, tailored specifically for sentiment analysis. A broker report is unstructured data. It's just text, right? Written by a human analyst at a bank somewhere.
Right, it's paragraphs of opinions and forecasts.
Exactly. So the AI scans all 6,000 reports, extracting key entities, company names, product lines, geographic regions. Then it analyzes the sentiment of the language surrounding those specific entities.
Like looking for tone.
Yes. Is the language becoming more cautious regarding supply chains in Southeast Asia? Is there an uptick in positive sentiment around a specific semiconductor component? The AI quantifies that qualitative text, turning it into a numeric risk score or a predictive signal that BlackRock's models can instantly act upon.
Wow.
No human team, regardless of size, could process and synthesize that volume of unstructured text with that level of speed and consistency. It's impossible.
And the results really speak for themselves. The sources note Siemens achieved a 10% boost in prediction accuracy by feeding data into advanced AI models that translated it into actionable insights. 10% on that scale is massive.
It's billions of dollars.
Right. And then we look at Microsoft. The deep dive sources mention they use machine learning to generate unbiased bottom-up forecasts. Let's clarify that term for a second for anyone listening. A bottom-up forecast.
Sure. A bottom-up forecast is built by aggregating data from the granular level up. So instead of the executive team just mandating a 10% growth target from the top down, a bottom-up approach looks at individual sales reps, specific product lines, and regional pipelines, and rolls all that data upward to create a holistic forecast.
And humans are basically notoriously bad at that because of inherent bias, right? Like a sales rep will sandbag their numbers to make sure they hit their quota, while a regional manager might inflate them to look good to the VP.
Exactly.
Yeah.
Human forecasting is plagued by optimism bias, anchoring, and just general political maneuvering within the company.
Right, office politics.
But a machine learning model doesn't care about office politics. It looks at the historical conversion rate of a specific sales pipeline, factors in current market conditions, and generates a mathematically objective forecast.
Okay, so that's predictive analytics. But the sources push even further into the future with a concept called agentic AI.
Yes.
And I'll be honest, this is where it starts to feel a bit like science fiction.
Agentic AI is the next major frontier, without a doubt. Right now, most AI usage is prompt-based. You ask a chatbot or a financial copilot a question, and it gives you an answer.
Right, like a really smart search engine.
Exactly. The AI is a passive tool waiting for human instruction. Agentic AI moves from prompt and response to autonomous action.
Wait, so the AI acts on its own?
Within defined governance boundaries, yes. These are AI agents designed to initiate and complete complex tasks with minimal human input.
Give me an example.
Okay, so an agent could continuously monitor market conditions in the background. If it detects a sudden tariff increase on a key component, it doesn't just send an alert to a human saying, hey, look at this. It autonomously initiates a workflow.
Oh, wow.
It updates the cost of goods sold forecast itself, it adjusts the pricing models, runs a scenario analysis on profit margins, and then drafts a recommendation email to the CFO.
So it's orchestrating a multi-step process across different systems.
Yes. And eventually, you have specialized agents working together. Say, an inventory management agent detects a shortage, and it communicates directly with a cash flow forecasting agent to see if there is liquidity to expedite a massive raw material purchase.
That's incredible.
Or it creates a highly dynamic, cohesive operational nervous system for the whole company.
Think about how traditional forecasting works for you listening. It is like steering a massive cargo ship by only looking at the wake behind you in the water. You know exactly where you have been, and you are trying to guess what is ahead based on the water you've already displaced.
It's exactly what backward-looking reporting is.
Right. But predictive analytics and agentic AI, they provide a radar for the waters ahead. You can see the supply chain bottlenecks, the inflation spikes, and the demand drops miles before you hit them, allowing you to actually adjust your course in real time.
It entirely changes the dynamic in the boardroom. When the CEO turns to the FP&A director and asks, what if the European Central Bank raises rates by 50 basis points next week?
The answer is no longer, let me get my team on that, and we will have a model for you by Thursday.
Right. The FP&A director can have their AI copilot generate a summary of the financial impact right there in the room, grounded in real-time data.
Now look, if we were to stop right here, this sounds like an absolute corporate utopia, perfect foresight, automated reporting, completely unbiased forecasting. But if it were that easy, every single Fortune 500 company would be running seamlessly on AI today.
And they very clearly aren't.
Right, they aren't. If these predictive models are so revolutionary, why did traditional machine learning usage and forecasting actually drop? Which leads us to the W in our SWOT analysis, the weaknesses. The friction points.
The gap between the marketing hype of AI and the practical reality of enterprise implementation is vast. You really have to look at the friction points objectively. According to the FP&A Trends Survey cited in our sources, machine learning usage in forecasting peaked at 11% in 2021, and by 2024 it had dropped to just 6%.
Wait, it actually decreased during the biggest AI boom in history?
Yes, it dropped by almost half. And furthermore, Only 12% of finance teams report successfully deploying machine learning models at scale.
12%.
More than a third of companies say they have absolutely no plans to adopt it at all.
That is a staggering disconnect. The technology is capable of reading 6,000 broker reports a day, analyzing global sentiment, and yet 88% of finance teams can't deploy it at scale. What is breaking down?
It comes down to internal weaknesses in both the technology itself and the organizational infrastructure. Let's start with the technology, specifically the hallucination problem in generative AI.
Ah, yes. The hallucinations.
We talked about how great natural language processing is for drafting management commentary, right?
Right, writing the summaries.
But the research shows that hallucination rates in financial NLP can run as high as 41%.
41%. That means almost half the time the AI is just making things up.
It does. And to understand why, you have to understand the mechanism of a large language model, or LLM. An LLM is not a calculator. It is a probability engine. It does not perform mathematical logic. When you ask it a question, it is mathematically guessing the next most statistically likely word or token in a sequence based on its training data.
Wait, so if it sees the phrase revenue increased by, it just guesses the next word based on historical text patterns rather than actually understanding the revenue data spreadsheet you fed it?
Exactly.
Yeah.
It's playing a highly advanced game of autocomplete. It might generate a highly confident, beautifully written sentence that says, revenue increased by 15% due to strong sales in Asia, when in reality, revenue decreased by 2%.
Oh, wow.
It hallucinates facts because it is prioritizing linguistic fluency over factual accuracy.
I mean, I have to challenge the entire efficiency argument then. Corporate finance requires deterministic accuracy. 2 plus 2 must always equal 4.
Always.
If I am an analyst and the AI drafts my variance commentary, but I know it has a 41% chance of hallucinating a number, I have to aggressively scrutinize every single sentence. Am I actually saving time if I have to act as a forensic auditor for my own AI tool?
In many cases, no. And this is exactly why adoption has stalled. Taking a probabilistic tool, one that guesses, and forcing it into a deterministic discipline, one that requires absolute precision, it creates massive workflow friction. The review process often takes longer than the creation process would have taken manually.
Wow. And this weakness isn't just limited to writing text, is it? It extends to complex financial modeling as well. Our sources cite a study by Wall Street Prep that tested leading AI tools on real-world financial modeling tasks.
Yes, and the results of that study were very revealing. They found that the best AI performers still underperform a junior human analyst when dealing with messy data, large files, and iterative model building.
Now, that just sounds crazy to me. Why does a supercomputer underperform a 23-year-old junior analyst on Excel? Doesn't the AI have infinitely more processing power?
It has process power, absolutely, but it lacks contextual business logic.
What do you mean?
Corporate financial models are not just pure math. They encode human assumptions, strategic pivots, and historical quirks of the company. The AI can execute the arithmetic flawlessly, but it doesn't understand the why behind the logic. It doesn't know that a specific customer region is coded differently in the system because of a messy corporate merger 3 years ago. When it encounters that messy, idiosyncratic data, it just breaks.
Which perfectly transitions us into the biggest organizational weakness mentioned in the sources, data quality and what they call workflow debt.
Yes, this is the crux of the entire adoption failure. AI cannot fix bad data. And let's be real, in most companies, the data foundation is an absolute disaster.
It's all just taped together.
Exactly. Product names are spelled differently across systems, customer records are duplicated, and revenue is categorized differently by the sales team than by the accounting team.
The sources mention a concept from Bain called workflow debt. Let's define that for a second.
Sure. Workflow debt occurs when a company tries to bolt new, advanced AI tools onto existing, broken, spreadsheet-driven processes without actually redesigning the underlying work.
Right.
It is the technological equivalent of putting a Formula One engine inside a rusty 1995 commuter car. The transmission will immediately blow.
That's a great visual.
If your underlying data pipelines rely on analysts manually emailing Excel files to each other, Adding an AI agent on top of that
Right.
will only automate the generation of bad insights.
So these companies are just stuck. They buy an expensive AI tool, they point it at their messy, fragmented data. The AI generates a hallucinated forecast, and the finance team naturally loses all trust in the system.
And so what do?
They go back to running their old manual Excel processes in parallel just to be safe.
Exactly. They double their workload.
Man. So the benefits of AI are completely neutralized. As the literature notes, the true competitive edge in AI isn't building a smarter algorithm, it's cultivating smarter data.
Yes. The algorithm is commoditized now. Anyone can buy it. Your proprietary, clean data is the actual differentiator.
So we have severe internal friction, workflow debt, fragmented data, and probabilistic models hallucinating in a deterministic field. But as frustrating as an internal headache is, there are far more severe external dangers that could actively damage the business.
This is where things get really serious.
Right. This moves us to the T in our SWOT analysis, the systemic risks and threats of AI implementation.
The threats are where this shifts from an IT problem to a board-level legal liability. And the most prominent threat discussed in the literature is the black box dilemma.
Okay, let's unpack the black box. Because when we talk about advanced machine learning, particularly deep neural networks, we are talking about systems that analyze millions of data points across thousands of hidden layers.
Right.
The dilemma is that even the software engineers who build these models often cannot explain the exact mathematical path the model took to arrive at a specific output. The internal logic is totally opaque. It is a black box.
Yes, and that is a massive problem in finance.
Right. If a CFO uses one of these models to justify a massive budget cut to a specific division, and the board demands to know exactly how that conclusion was reached, what happens?
The CFO cannot explain it. They can only say, well, the algorithm recommended it based on historical patterns. And in a highly regulated environment, the computer told me to, is not a legally defensible position.
And regulators are catching up to this very quickly, aren't they?
Oh, they absolutely are. The upcoming European Union AI Act, which takes full effect in 2025, is going to drastically change the landscape.
Okay, what does that do?
Under this act, AI systems are categorized by risk. High-risk AI systems in finance, such as those used for credit scoring, algorithm trading, or critical risk assessment, they require strict transparency. You must have detailed documentation, robust risk mitigation systems, and clear human oversight.
And if a global bank is using a black box model for credit scoring, and they cannot mathematically explain why it denied a loan to a specific demographic, what is the penalty under the EU AI Act?
The non-compliance penalties are existential. Fines can reach up to 6% of a company's global annual turnover.
Just to be perfectly clear for you listening, turnover means total revenue, not profit.
Correct. Total global revenue.
That's insane. A 6% fine on gross revenue could wipe out a company's entire profit margin for the decade.
Exactly. The lack of explainability is no longer just a technical annoyance. It is a massive financial threat.
But the threats aren't just regulatory either. There is a massive operational threat regarding cybersecurity and data privacy. To get the most out of these AI models, especially generative AI, you have to feed them context.
You do. They need data to work.
And in FP&A, that context is the absolute crown jewels of the corporation. We are talking about forward-looking profit margins, unreleased product development costs, precise pricing matrices, and executive payroll structures.
Which creates a massive vulnerability. Let's say a well-meaning analyst takes a highly sensitive spreadsheet of upcoming merger and acquisition targets, and they upload it into a public large language model just to get a quick summary. They have just ingested proprietary corporate data into a public system. That data can be used to train future versions of the public model, potentially exposing it to competitors.
Wow.
Or, if the company is using a multi-tenant cloud AI provider, a breach in that system exposes their deepest financial secrets.
The sources explicitly warn that financial institutions are prime targets for cyber attacks, and unsecured AI pipelines basically act as an open backdoor into the most sensitive data a company holds.
It's a huge vector for attack.
But even if the data is perfectly secure, the models themselves pose a threat through degradation.
The sources mention model drift and algorithmic bias.
Yeah.
How does a mathematical model become biased?
Because a mathematical model is trained on human data. If a bank trains its AI on 30 years of historical lending data, and that historical data contains systemic discriminatory practices against certain neighborhoods or demographics, the AI will learn those patterns.
Because it just sees a correlation. It doesn't understand ethics. It just sees a statistical correlation. It will then automate and scale that historical prejudice, denying loans or undervaluing assets based on biased logic.
It mechanically quantifies past prejudices into future automated decisions.
Exactly. And model drift is a related threat. An AI model is optimized for the specific environment in which it was trained. If an FP&A team trains a predictive model on supply chain data from, say, 2015 to 2019, the model assumes a relatively stable global shipping environment.
Right.
But when a massive global pandemic or a geopolitical crisis hits, the underlying reality changes. But the AI is still operating on the old assumptions. The model drifts away from reality, losing its accuracy and generating severely flawed forecasts that can lead leadership right off a cliff.
It's like blindly trusting your GPS when a new highway was just built, and the GPS tells you to drive straight into a lake because it hasn't updated its map.
That is a perfect way to visualize model drift. You have to continuously monitor and retrain the models, which, again, requires significant human oversight.
There is one more systemic threat mentioned in the sources that I found absolutely fascinating from a macroeconomic perspective: herding behavior.
Ah, yes. This is a major concern for market stability. We are seeing a homogenization of AI tools right now. Many hedge funds, banks, and corporate finance departments are licensing the exact same foundational AI models from the same few massive tech companies.
So what happens when thousands of financial institutions are all using the exact same underlying algorithm to forecast market movements?
You get algorithmic herding. If a macroeconomic trigger occurs, say an unexpected jobs report drops, and all of these identical AI models interpret that data in the exact same way, they will all generate the exact same signal simultaneously.
Boy.
If the AI tells thousands of institutional traders to sell a specific asset class at the exact same millisecond, they all execute the trade at once.
Which creates a self-fulfilling market crash. I mean, we've seen miniature versions of this with quantitative trading flash crashes in the past, but AI scales it across the entire corporate ecosystem. There is no human contrarian thinking to balance the market. The algorithms herd together and exacerbate volatility.
It's a very real systemic risk.
So we have unpacked an incredibly complex landscape today. We have the massive opportunity to automate weeks of manual work, reduce daily errors, and predict the future with real-time scenario modeling.
Right. The strengths and opportunities.
But those strengths are offset by 41% hallucination rates, severe workflow debt, unexplainable black boxes, and the threat of billion-dollar regulatory fines. So what does this all mean? If I am an FP&A analyst or a controller listening to this right now, how do I actually navigate this landscape tomorrow morning? This shifts our discussion to the action plan.
The action plan detailed in the literature requires abandoning the idea of full automation. You do not just hand the keys of the finance department over to an AI agent.
Right.
The recommended approach is what they call a constraint-aware framework.
Constraint-aware, meaning you implement the AI, but you build strict fences around what it is actually allowed to do.
Precisely. The core philosophy here is graduated augmentation. You augment the human, you do not replace them.
Let's break down graduated augmentation in practice. What does it look like?
It means delegating specific bounded tasks. You let the AI handle the high-volume data aggregation. You let the RPA bots pull the CSV files from the ERP and standardize the formatting.
Getting rid of the grunt work.
Yes, you let the machine learning algorithms run the baseline variance analysis and detect the anomalies. You let the natural language processing draft the initial rough summary of the data. The AI acts as the ultimate engine of productivity for the heavy lifting.
But the human retains the final authority.
Exactly. You leave the material judgments, the irreversible financial actions, and the strategic commercial recommendations to the human professionals. The AI might suggest that a budget cut is mathematically viable, but the human understands the political and morale implications of cutting that specific department. AI augments your analytical capacity, but the human retains ultimate accountability for the outcome.
To make graduated augmentation work, though, the skill set within the finance department has to evolve, right? The sources point out the rise of entirely new roles within FP&A to manage this technology. We aren't just hiring traditional accountants anymore.
No, the modern finance team requires hybrid skills. The literature specifically highlights two emerging roles: the FP&A data scientist and the FP&A architect.
Let's define those. Because, honestly, an FP&A data scientist sounds like a software engineer who just got lost on the way to the IT department.
They are the crucial translator between IT and finance. Traditional IT data scientists know how to build machine learning models, sure,
Hmm.
but they don't know the difference between EBITDA and operating cash flow. On the flip side, traditional finance analysts know the accounting rules, but they don't know how to query a database using Python. The FP&A data scientist bridges that gap. They are finance-savvy professionals who understand how financial models work, but also know how to tune machine learning algorithms to support dynamic forecasting.
Okay, that makes total sense. And what does the FP&A architect do?
The architect governs the overall infrastructure. They are the ones solving the workflow debt problem we discussed earlier. Their job is to ensure that data flows securely and seamlessly across the ERP systems, the proprietary databases, and the AI models.
Building the actual pipes.
Exactly. They ensure the AI is being built on a clean, unified data foundation, and they monitor the systems to prevent model drift and ensure compliance with things like the EU AI Act.
So for you listening, if you want practical, actionable steps you can take this quarter to start this transition safely, what is the playbook?
First, start small. The biggest mistake companies make is trying to reinvent their entire annual operating plan with AI on day one. It will fail.
Don't boil the ocean.
Right. Identify one specific bounded area with high manual effort like automating variance analysis for a single product line, or using an LLM to summarize vendor contracts. Run a pilot program, prove the value, and learn the friction points in a low-risk environment.
And second.
Do not wait for perfect data.
But wait, we just said bad data breaks the AI.
It does. But if you wait for your enterprise data to be perfectly clean, you will literally never start. You have to run in parallel, implement small AI pilots, and use the failures of those pilots to highlight exactly where your data hygiene needs to improve. The AI will quickly show you where your data is broken, allowing you to fix it iteratively.
That's a great point. And from a governance perspective, the sources really emphasize involving internal audit and legal teams early. You must ensure you are using secure, enterprise-grade AI environments, closed networks, where your proprietary data is not used to train external public models.
Governance cannot be an afterthought. It must be built into the deployment from day one.
I think the most important takeaway for the human professional feeling anxious about this whole shift is that AI is not a substitute for your emotional intelligence. It cannot build trust with a skeptical board of directors. It cannot negotiate a delicate compromise between two warring department heads. And it does not possess fundamental business acumen.
No, it doesn't.
The sources summarize this brilliantly. You do not grab a screwdriver to hammer in a nail. AI is a tool. You must use the right tool in the right way to solve specific mathematical and data problems. The technology delivers the output, but the human delivers the outcome.
The machine provides the numbers, but the human provides the meaning.
I love that. Let's bring this all together. We have explored a massive structural shift in corporate finance, from backward-looking reporting to forward-looking prediction. We see the strength in the undeniable power of automation, using RPA and machine learning to clear away the manual data wrangling that causes burnout and daily errors.
Yeah.
We see the opportunity in predictive foresight using AI to run dynamic scenarios and autonomous agents to orchestrate complex workflows. We acknowledge the severe weaknesses in the reality of workflow debt, fragmented data, and the massive friction of probabilistic AI hallucinations in a field requiring deterministic accuracy.
Right.
And finally, we covered the systemic threats. The unexplainable black box, the existential fines of regulatory acts, cybersecurity breaches, and the danger of algorithmic herding. By understanding this entire landscape, professionals can implement graduated augmentation, ensuring they control the technology rather than being overwhelmed by it.
It really is about moving forward with eyes wide open, embracing the efficiency while actively managing the profound risks.
Absolutely. Now, as we wrap up this deep dive into the sources, I want to leave you with a final provocative thought to ponder.
Oh, this should be good.
We talked extensively about agentic AI autonomous agents acting on behalf of a company. Imagine a near future where this is the absolute standard across the global economy. You have autonomous AI agents at Company A negotiating supply chain contracts, planning budgets, and forecasting demand directly with autonomous AI agents at Company B.
Basically machine-to-machine commerce.
Exactly. If the algorithms are entirely running the supply and demand curves, optimizing against each other in real time at the speed of light, does financial forecasting simply become a closed-loop system? Does the global market stop being a reflection of human behavior and instead become a self-fulfilling prophecy dictated entirely by algorithms talking to algorithms?
That is profound.
Right. And if the ecosystem itself becomes purely mathematical, where does human intuition, the gut feeling of a seasoned executive, actually fit into a fully automated economy.
When the entire market infrastructure operates on autonomous code, the definition of what it means to be a financial leader will have to evolve completely.
Something to think about the next time you are manually updating an Excel cell. Thank you for joining us on this journey today. Keep questioning the tools you use, keep learning, and keep simplifying your workflow. We will see you next time.